Welcome back to the podcast, Mark.
Thanks, Andrew. It's great to chat again.
Yeah, I think the last time that you and I sat down on the podcast was back in the fall of 2023, and thought we would start there. I'd just like to hear your general thoughts on the investment landscape over the last 6 to 12 months. And in particular, I think many people are curious as to the job that central banks have had in trying to thread that needle of lowering inflation without causing too much harm to the economy. How is this reflected in the overall economy and among Canadian companies?
Yeah, I think it's a good place to start. The quite a bit of volatility, and read the news every day. Just the headlines have been can be quite dramatic at times, whether it's geopolitical risk or economic changes that are going on with higher rates. And when you zoom out and you look at longer term, we're actually seeing very healthy returns across equity markets, Canada, as well as internationally. And probably the most notable on the high end would be within the US. And when we zoom in a little bit more into Canada, what we really find is while the absolute level of returns is rather healthy and attractive, there is quite a bit of dispersion, and things are moving in different directions under the surface. So, for example, this year alone, if you look at the top really performing sectors that have actually been the top performing sectors in the last few years, energy and materials would be near the top, and those are earning really year to date, looking at mid-teens type returns. And on the other side of the equation, you have telecoms and real estate and some utility stocks that are really lagging the market and are down low single digits and even double digits. So quite a bit of dispersion across the landscape. And so when we think about, then we ask ourselves, really, what's driving that? And one, I think you pointed it out, and that's that the high interest rates are really just having the intended effect on the economy that they should. So they are slowing things down, but they are not hitting every area of the economy the same. So if we look at energy companies, a lot of them have already paid down a lot of debt, and their balance sheets are in pretty good shape. High interest rates may even be preventing some new projects from being invested in by energy companies. So we're not seeing tremendous amounts of growth CapEx there. And so that's causing relatively high commodity prices. And so energy companies are very happy to be producing at $80 oil. And the stocks have done well and reflected that because they can buy back stock and return lots of capital to shareholders. On the other side of the equation, on the consumer side, we're seeing a lot more noticeable slowdown in terms of demand trends. So one thing, a lot of companies out there reporting results recently, and a few maybe ones that most people might know, Lululemon, Nike, McDonald's, some of the auto sales numbers have not come in particularly strong. And those are things that are more driven by consumers really tightening up or feeling a little bit more the impact of higher rates. Similar with another area would be real estate, where a lot of these companies rely on debt to finance buildings that they're going to develop or acquire. And as those debt maturities are rolling over and they're refinancing them at higher rates, they're paying more, and that's eating into some of the earnings growth that they have. One last area that I'd comment within Canada that's particularly stood out, that's historically been quite defensive and had some growth with it, is the telecoms. And they're just continue to see a lot of the pricing challenges for the telcos, where it's become more competitive in the market. And we've talked about this, I think, Andrew, on prior podcasts. And that's an area where we've really de-emphasized as there are continued headwinds and just really competitive market intensity as players are looking to grab market share. So that's a little bit more unique within Canada.
So certainly just some dispersion in the market given the circumstances, and obviously central banks and monetary policy have certainly been a major factor for these last several years. But if we step back, there are other underlying themes out there that are playing out over much longer time horizons. And one of those longer term trends or themes playing out around the world is, I guess to use a very broad term, the energy transition. So That's certainly relevant for us here in Canada as a producer of both traditional and renewable energy sources. But this really touches many other sectors and presents challenges and opportunities for investors. How do you assess the impact of that transition on Canadian equities over the longer term?
Yeah, it's something that I think it's really important to highlight. It's a theme that we've talked about a lot internally and has certainly been out there in the press as a topic of not only government policy, but how companies are reacting. And I think from our perspective, one, we really take a bottoms up approach when we're looking to assess the impact of that longer term trend. And one thing we're really looking for is within each company, who's actually creating and driving the wealth creation amongst while this transition is happening. And so key questions we're asking is really where is there a need for capital in the economy because of this transition? And then from a regulatory perspective or a policy perspective, it's really, BJ likes to say, are we on the right or the wrong side of City Hall? And don't want to be in too many areas where we think, government could really be coming out with a policy that would negatively impact a particular business or business model. And then maybe lastly, just at the company level, we're looking at capital allocation decisions. And are they going towards energy transition projects that are very high return on capital and within the core competency, or are they really outside the core competency and very low return on capital? And that is some of the key questions, and that's from a bottom-up level. From a top-down level, if we think about Canada as a whole, we're fairly well positioned from an energy production standpoint. If you look at the power grids, both Ontario, Quebec, as well as BC, largely have a lot of hydro and nuclear power driving most of the energy grid. And then even in Alberta, there's been a huge shift away from coal powered, and those plants have been transitioned to natural gas fired power plants. And so there's been a huge reduction, even within Alberta, of the amount of emissions coming from power plants over the last 20 years. And it's actually been much ahead of schedule within Alberta. So the country as a whole has really worked and transitioned large components of the energy grid. And from a natural resources perspective, that's another big opportunity longer term for Canada. So if you look at the critical minerals landscape, lots of resources and reserves within Eastern Canada as well as British Columbia and up north, and that could be a very good long-term strategic asset for the country to develop and responsibly produce. I think the one other element that we need to really evaluate closely that I'd highlight is different from the US is really the IRA in the US and the Inflation Reduction Act. And so far, Canada doesn't really have a regulatory incentive framework that is on par with that. And a lot of competing nations around the world are thinking about, okay, how can we develop a system that isn't going to cost an enormous amount that's going to really strain fiscal budgets, but isn't going to result in all of our companies and intellectual capital going to the US to be invested there. And so Canada so far, there's more carbon tax framework, whereas the US, it's really more tax incentives and outright cash payments to companies making certain investments. So it's a much more carrot approach in the US. And that's one thing that we're closely watching as it evolves. So hopefully that's a little bit of an overview. Happy to get into some of the company-specific ideas as well.
Yeah, that'd be great, actually. And that was going to be one of my follow-up questions. Just, what are some of the sectors or business models that you and the team are spending the time discussing within this realm?
Sure. Maybe I'll start with just an obvious one that is somewhat counterintuitive just because of the industry reaction, and that's the energy landscape. So one thing that we've seen and seeing continued forecasts that are updated annually on this is really the just demand for oil longer term. And that's been a big question of why own an oil and gas company if a lot of these technologies like electric vehicles are going to displace demand for gasoline longer term. And the other side of that is, well, there's emerging markets that continue to grow. And as people become wealthier on a per capita basis, they do tend to consume more energy. And there's also the industry reaction that you have to factor in. And what we're seeing, especially within Canada, but also elsewhere, is we're not seeing very high levels of capex to go into new projects. And so that reaction to some of the maybe threats out there longer term has actually created a very positive environment. So it's oddly been a very good time to be invested in the energy landscape, and that could continue for a long time to come. Utilities would be another one there where it gets a lot of attention, and we have some exposure within the Canadian equity strategy. And really, there's a couple things that I'd highlight. One, they're investing to bring on a new production. And so that might be new renewables or just new gas-fired power plants that need to be built to sustain the power demands that are coming from sorts of avenues. And more recently, AI has been a big potential driver or incremental change to that longer term. And within the Canadian equity strategy, we see companies like Fortis, Hydro One, AltaGas, they're all investing more and more every year and building the rate base up, which ultimately will grow earnings for them over time. And then one that maybe is less evident on it is really Brookfield. And they have a very large renewables platform across US and Europe. And they were very well positioned before the Inflation Reduction Act was passed. And that platform that they have, really, if you think about what happened with the Inflation Reduction Act, is it created added incentive to go do a lot of these renewable projects in an effort to accelerate that investment and that transition to cleaner fuels. And similar to maybe the analogy would be you're building a house, and all of a sudden the government says, every new home that's built, we're going to give the developer $100,000. Well, that immediately gets priced into the market. And so for new homes that maybe someone's looking to buy, well, the home price is going to reflect that new incentive that's in the market. But for all of the incumbent competitors that have built and established large renewable platforms like Brookfield, they immediately get that uplift in value because all of their projects all of a sudden are now getting this incremental benefit that they maybe didn't underwrite in the first place. So that would be one area that I'd highlight within the Canadian equity strategy. And then another big one that we've talked about internally and assessed and talked to companies about is just climate change and the impact that is having. And one company in particular that we think could potentially benefit from this longer term is Intact. And so what's happening with larger weather events that are more frequent and costing more over time is that's driving the need for insurance and growing the risk pool over time. And that can ultimately lead for premium growth. On the other side of that, it can create a risk, but we think companies like Intact have historically done a very good job in terms of pricing that risk, and then they can incrementally adjust as more data comes out and really reprice that book on an annual basis as they see the risks change in the market. And then the other tool that they have that's really nice longer term is just a reinsurance option where they can cap limits to certain events, whether it's geographic areas or types of events that are happening, so they're not overly exposed. Another one that's somewhat utility related and also somewhat climate change related within the Canadian equity strategy would be Stella-Jones. And so Stella-Jones, a big part of their business comes from utility poles, and utilities have been investing more aggressively in recent years to really drive down some of the age of the poles within their network. And so that helps just the overall strength of the poles, and they're newer and maybe less brittle. And then they're also doing things like purchasing more fire-wrapped and weather-resistant poles that Stella-Jones is producing. And so that's a nice benefit and tailwind for a company like Stella-Jones in the portfolio. And maybe lastly, related just to the mining and the critical minerals that we have within Canada and elsewhere in the world, I'd highlight within the Canadian equity strategy would be Finning and Tormont. So both Caterpillar dealers, and both stand to benefit tremendously longer term as they sell more to the mining companies, but then also attach higher margin product support and services to service those vehicles once they're out in the field and are out in the mine working. And so those would be a few areas that I highlight within this energy transition that we think just provide longer term tailwinds. It may not be the core thesis that drives every single investment, but it's certainly a tailwind and a factor that we're closely assessing. So, Andrew, when we think about really the so what's in the Canadian equity strategy for some of just the dispersion and differences we're seeing, really, I think one that creates opportunities. And so when we go back to just our process internally here, it's having inventory lists of stocks that we don't own that we would love to own, maybe at the right price, or if something changed fundamentally about the business. On the other side of that, this high level of dispersion can present a lot of risks. So if you have big bet within one particular sector or area and of the market or type of business model, that call is really wrong for a period of time, that also presents risks. So we're constantly kind of asking ourselves, do we have sharp edges in the portfolio? And are there ways to mitigate or better position the portfolio just in the current environment? And one just simple, really heuristic that we use when we're going through the portfolio and looking at the construction of it and the different types of companies within it is we just ask ourselves really a simple question of where do we have headwinds and which companies have tailwinds. And when we think about some of the headwinds, which we can get to later a little bit, is real estate. Those companies, whether it's some Colliers, even Brookfield Asset Management, somewhat on the fundraising side more recently, has had some headwinds. And banks would be another area that we can touch on in more detail where they've faced some headwinds. And so as a result, we've actually pared those positions back a little bit and try to reflect some of that in the portfolio weighting and how large of exposure we want to those businesses at this point in time. And then on the other side of that, there's companies that still are doing very well. So technology companies, some of those companies are not highly affected by higher interest rates because they have maybe little or no debt. So companies like Constellation Software and Topicus continue to go and execute their business model and continue to roll up attractive software businesses at good prices and grow that way over time. And Loblaw would be another one where they've really benefited in this current environment where you've had some food inflation and broader inflation. And so consumers are really shifting to discount banners. And they have, with Superstore, they have a very large discount market share. And so they're, in our assessment, is gaining market share. And that's helped. And the Shoppers Drug Mart business is also performing very well. And then the last one would be energy companies and Canadian Natural Resources in particular. And even Suncor is performed well of late, where, as I mentioned, these companies have paid down a lot of the debt. So now they can really accelerate that cash flow return to shareholders through dividends and buybacks. So that's just a simple heuristic where we think about just headwinds and tailwinds. And then the inventory list being another key part of the process to just build that portfolio and factor in some of these macroeconomic forces into the portfolio level weightings.
Yeah, I really appreciate that response, Mark. It's some great context to a very broad and, as you just highlighted, far-reaching topic within not just the Canadian space, but globally speaking as well. Before I let you go, I wanted to come back to some of your earlier comments and build on some of what you just touched on, at least in terms of insurance companies. I'm curious of how the holdings within the insurance and the banking space are doing. Both of those business models are, one, prevalent in the portfolio, and they're both impacted by the uncertainty around interest rates, as well as whatever degree of probability we have around a potential slowdown for the consumer or economy. What's been happening with those stocks lately?
Yeah, it's been quite the time for banks and insurance companies recently, just with the level of changes going on from a regulatory perspective and looking across the economy as well. Maybe I'll start with banks. And one, you can think of banks maybe in simple terms as business model that's fairly exposed to economic growth and also economic contractions. And we're seeing a slowdown in growth, the banks are feeling that as well. And so they see that in terms of loan demand slowing. They continue to really move provisions higher for loan losses. And so that reduces their level of earnings. And they're also dealing with costs and just inflation across their core businesses, whether that's services they purchase, software, hardware, but also on the labor front in a tight labor market. And so they've had to deal with that. And then a capital markets business that they have as well. While equity markets have been rather strong, it has been a slower environment for things like M&A and IPOs in the market. So that's an area of the bank where they've felt a little bit more pressure. And then lastly, because we're now getting reasonable returns on cash deposits, a lot of consumers and businesses are looking to deploy those into and move them outside of maybe a bank and into some type of money market fund or strategy where they earn a higher return, or even a fixed income strategy. And so that creates some funding pressure and margin pressure on the banks. If I switch to Lifecos, they don't have the same level of deposit movement that a bank would have. And so if you purchase a life insurance policy, maybe you bought that policy up front and you're paying some fixed amount every year in premium, or alternatively, if you bought some annuity, you pay some amount up front and you get some guaranteed return or even a variable return over the life of that annuity. And that doesn't have the same redemption and liquidity risk that you might have in a deposit at a bank. And so that has been more beneficial to them, as you can think of Lifecos as really a large fixed income portfolio. And so they've benefited from that, and just higher interest rates, then their ability increases to reinvest their cash flows at higher interest rates. They don't have the capital markets businesses that the banks have. And there are also very big wealth management franchises within both companies in the Canadian equity strategy. Manulife is a very large wealth management franchise that spans within Canada, but also internationally. And IAG also has a wealth management strategy that's grown over time. And so that combination of business mix is really helped. And then one thing I'd highlight too, in particular with Manulife, it's been one of actually the strongest performing financials across banks and life insurance companies now for the last 5 years. A lot of that strength really coming in the last year, benefiting from finally getting rid of some of these variable annuity, long-term care policies that were written a long time ago in these legacy contracts. As they've matured, there's more data on them, and they're producing a little bit more reliable stream of predictability for whoever owns them. And so with that combination with higher rates has allowed them to reinsure those and sell some of those. And as those legacy contracts have become a lower proportion of Manulife's earnings, you're seeing just a better earnings mix and a higher ROE earnings mix. And so that's a business that's actually performed relatively well of late. And that's also within the Canadian equity strategy. So I think I'd highlight that as one example where just a different dynamic going on than the banks.
Yeah, I know that in past conversations with you and VJ, that's certainly been a topic with Manulife and how they can improve their earnings mix going forward. So it's nice to hear an update on that. I think it's a great place to wrap things up too, Mark. I'm sure between now and the next time we chat, we'll have more news on all of these topics that we talked about. And we talked about a pretty wide range of them and likely some different themes emerging as well. So thanks for spending some time today, and looking forward to the next time we get to catch up.
Happy to. Thanks, Andrew.